Tesla's trillion-dollar empire is built on a foundation of sand, and Elon Musk's greatest achievement might become America's most dangerous vulnerability. While millions of Americans celebrate Tesla as the symbol of innovation and clean energy leadership, a hidden crisis threatens not just the company, but America's entire technological sovereignty. What if I told you that the world's most valuable automaker has become dangerously dependent on its greatest geopolitical rival? And this dependency could determine whether America wins or loses the economic war of the 21st century. Stay with me until the end, because what I'm about to reveal will change how you see Tesla, China, and America's future forever. We're living through what many call the electric vehicle revolution, a transformation that promises to reshape transportation, reduce carbon emissions, and position America as the leader in clean technology. Tesla sits at the center of this revolution, valued at over $800 billion and commanding a market presence that dwarfs traditional automakers. Elon Musk has positioned himself as the visionary leading humanity toward a sustainable future, with Tesla as the vehicle for American technological dominance. The company's gigafactories represent modern marvels of manufacturing. Its supercharger network spans continents, and its full self-driving technology promises to revolutionize how we move. But beneath this shining exterior lies a web of dependencies that threaten everything Tesla claims to represent. The promise seemed perfect when Tesla announced its expansion into China. The world's largest electric vehicle market offered unlimited growth potential, lower manufacturing costs, and a pathway to global dominance. Tesla's Shanghai Gigafactory became a symbol of successful international expansion, producing over 950,000 vehicles annually and generating billions in revenue. Wall Street celebrated as Tesla's stock soared, investors cheered the company's global reach, and Musk was hailed as a strategic genius who had unlocked the key to sustainable profitability. The Shanghai facility delivered over 3 million vehicles in less than 5 years, accounting for more than 40% of Tesla's total global production. China became Tesla's second-largest market, generating over $9 billion in revenue and representing 25% of the company's global income. But here's where the story takes a dark turn. Tesla's success in China created a dependency so profound that it fundamentally altered the company's strategic position and exposed America's technological crown jewel to unprecedented risks. The Shanghai Gigafactory isn't just a manufacturing facility, it's become the beating heart of Tesla's global operations, producing exclusively Model 3 sedans and Model Y crossovers that serve both domestic Chinese demand and export markets across Asia-Pacific and Europe. This concentration of manufacturing represents an unprecedented level of dependency for a major American automaker, particularly given the escalating tensions between the United States and China. The dependency extends far beyond manufacturing into the critical arteries of Tesla's supply chain. Approximately 39% of Tesla's battery supply chain materials come from Chinese companies, making China Tesla's largest supplier of lithium-ion battery materials. Companies like Ganfeng Lithium, Novaray, and Zhejiang Huayu Cobalt have become essential partners, with some Chinese suppliers receiving choke point scores as high as 7.1 on a 10-point dependency scale. China controls approximately 80% of global lithium-ion cell manufacturing and an even larger share of key materials like lithium hydroxide and cathode active materials. This isn't just about business relationships. It's about America's most valuable technology company being fundamentally dependent on a foreign power for its most critical components. The illusion of Tesla's dominance began cracking in 2024, but 2025 has revealed the full extent of the crisis. Tesla's market share in China's battery electric vehicle segment has collapsed from 11.44% in early 2024 to just 6.36% in May 2025. This isn't just a slight decline, it's a competitive catastrophe in the world's largest electric vehicle market. Tesla's retail sales in China declined year over year in 4 out of 5 months during early 2025, with particularly severe drops including a 30% year-over-year decrease in May 2025. In the first 5 months of 2025, Tesla's retail sales in China totaled only 201,926 units, representing a 7.82% decrease even as the overall Chinese electric vehicle market continued expanding. What makes this collapse particularly alarming is the rise of Chinese competitors who have systematically dismantled Tesla's competitive advantages. BYD has successfully overtaken Tesla as the world's largest seller of battery electric vehicles, delivering 416,000 vehicles in the first quarter of 2025 compared to Tesla's declining global deliveries. Chinese brands like Xiaomi have launched vehicles positioned directly against Tesla's Model 3, offering competitive features including City Navigate on autopilot functionality for approximately $27,760, significantly undercutting Tesla's pricing. These aren't just cheaper alternatives. They're technologically competitive products that threaten Tesla's market position across multiple segments. But here's the twist that changes everything. Tesla's challenges in China aren't just about market competition. They're about regulatory control and technological constraints that expose the fundamental vulnerability of American companies operating in authoritarian markets. Chinese regulations effectively prevent Tesla from transmitting driving video data outside China, while U.S. government restrictions prohibit Tesla from conducting AI model training within China, creating a technological impasse that limits Tesla's ability to develop and deploy advanced features like full self-driving in the Chinese market. Tesla has been forced to establish dedicated data centers in China, commit that all data collected from vehicles remains within Chinese borders, and accept that surveillance data captured by vehicle cameras is stored offline and inaccessible remotely. The regulatory environment has become increasingly restrictive, with Tesla forced to halt its full self-driving trial in China in March 2025, pending new regulatory approval requirements. Chinese authorities have banned the use of terms like smart driving, autonomous driving, and full self-driving in marketing materials, forcing Tesla to rebrand its FSD package as Intelligent Assisted Driving in China. Chinese military facilities and government locations have prohibited Tesla vehicles from entering due to concerns about onboard cameras and data collection capabilities. These restrictions don't just limit Tesla's business operations. They demonstrate how American technology companies can become subject to foreign government control when they become dependent on overseas markets. The financial consequences have been devastating. Tesla shares dropped over 15% in a single day in March 2025, erasing approximately $127 billion from the company's market value, and bringing total 2025 losses to over 40%. By June 2025, Tesla's market capitalization had shrunk by 29.3% year-to-date, representing a loss of approximately $380 billion, and marking one of the largest value destructions among major companies. Tesla reported its first annual global sales decline in over a decade, with first-quarter deliveries falling 13% year-over-year. The company's net income plunged 71% in the first quarter, with Tesla only managing to record a profit due to $595 million in regulatory credit sales to other manufacturers. What comes next will surprise you. Tesla's crisis isn't just about one company's strategic mistakes. It's a preview of what happens when American technological leadership becomes dependent on foreign powers. The automotive gross margin fell from 28% in 2022 to just 13.6% in the most recent quarter, while competitor BYD reported a margin of 22.3% in the same period. Tesla's global revenue grew just 1% to $97.7 billion in 2024, while net profit plummeted 52% to $7.2 billion, indicating fundamental challenges in the company's core automotive business. The geopolitical implications extend far beyond Tesla's financial performance. The ongoing US-China trade war has created direct operational challenges, with Tesla forced to halt new orders for US-imported Model S and Model X vehicles in China due to retaliatory tariffs raised to 125%. Import taxes on critical materials and Chinese-made battery components have increased total vehicle costs by 9 to 12% depending on the model, creating significant margin pressure. Tesla's exposure to these tariff impacts is greater than many competitors due to its continued use of US-based production for exports and heavy reliance on Chinese suppliers for critical components. Here's the most alarming revelation. Tesla's deep integration with Chinese operations creates strategic vulnerabilities that extend beyond normal commercial risks. The company's dependence on China for manufacturing, supply chains, and market revenue creates exposure to potential disruptions from geopolitical conflicts, policy changes, or economic sanctions. Tesla's position as a foreign technology company operating critical infrastructure in China raises questions about the security and resilience of American technological assets. The strategic vulnerability is compounded by the difficulty of diversifying away from China operations given the scale of Tesla's investments and the unique advantages of Chinese manufacturing ecosystems. Tesla's Shanghai Gigafactory represents billions in invested capital, established supply chains, and operational expertise that would be extremely difficult and expensive to replicate elsewhere. This creates a form of strategic lock-in that limits Tesla's flexibility to respond to changing geopolitical conditions or policy environments. While Tesla has begun efforts to diversify supply chains, including investment in a dedicated lithium refinery in Texas, expected to produce enough lithium for approximately 1 million electric vehicles. By 2025, the scale and complexity of Tesla's China integration make rapid changes extremely difficult and expensive. The implications for America's technological sovereignty are profound. China's dominance in battery material processing, Tesla's dependence on Chinese suppliers, and the rise of Chinese competitors demonstrate how quickly technological leadership can shift when strategic dependencies aren't carefully managed. Tesla's experience serves as a warning about the risks facing other American technology companies operating in increasingly complex geopolitical environments. The convergence of manufacturing concentration, supply chain vulnerabilities, declining market position, regulatory constraints, and geopolitical tensions has created a perfect storm that exposes the fragility of America's technological advantages. Tesla's crisis reveals a fundamental truth about 21st-century economic competition. Technological leadership without strategic independence is ultimately vulnerable to foreign control. The company's dependence on China represents more than business risk. It's a national security concern that demonstrates how America's most innovative companies can become pawns in global power struggles. As Tesla navigates these challenges, the company's ability to maintain technological leadership while reducing strategic vulnerabilities will determine not just its own future, but America's position in the global technology race. The next few years will reveal whether American innovation can overcome strategic dependency, or whether our greatest technological achievements will become tools in the hands of our competitors. What happens to Tesla in China today could happen to Apple, Google, and every other American technology giant tomorrow. And that story is one we'll explore in our next investigation into America's hidden technological vulnerabilities.